Today, let's speak to the largest issuer of gold ETFs on the planet, Akash Doshi from State Street, after the bell. I didn't know if we're going to get the Yellowstone music, and I had to put my cowboy hat on. Well, hey, gents, how are you? Akash Doshi, upper left-hand corner. Names coming in, and it's a little surprise. I didn't want to say it pre-opening. We got two special guests with us, Bobby Iancino and Jim Urio. How do I do with those names?
Amazing.
And the weird thing is, I know you guys, and I'm
right. We hung out, and you still can't pronounce our names.
Crazy. Akash, thanks for coming on. So, Akash, tell us a little bit about yourself first. You're with State Street. I didn't get all of the investment management part, but tell us all about it. And from my understanding, we're going to dig deep into gold today. So let's do it.
Absolutely, Lex. It's a pleasure to be here. State Street Investment Management is the fourth largest asset manager in the world and one of the largest issuers of ETFs, or exchange traded funds, globally. And we have a gold suite. We were the first ones to launch a physically gold-backed ETF 21 years ago now, in 2004, and it is now the largest gold ETF or commodity suite on the planet, with assets under management as of July 14th, roughly around $112 billion.
Wow, that's huge. So, Bob and Jim, I was telling Akash when we had our kind of prelim call that I think our firm, when I was on the floor, was specialist or DPM in the GLD product and options way back when. Do you guys trade that at all? You two?
Sure.
Yes.
Yeah.
Quite a bit.
Yeah. All right, cool. Yeah, so I think that I remember that correctly. I remember seeing that on our books a lot. So we had a lot of that product, Akash. All right, let's get started. We got a lot to cover. We're going to do 2 episodes with Akash. This is number 1. We don't have a cool name for it yet. We will have number 2. Still don't have a cool name for it, but we're going to do it. So I'll start it going. You guys go at it, and I'm going to kind of pull you apart and go to the next question, all right? Because I know you guys could go on forever, right? All right, let's get moving. So gold was a top-performing major asset class in 2024, right? And it's a top-performing asset in 2025. So, Akash, where does it go from here? What's your base bull and bear case for this yellow metal? And you guys jump into and help me out.
Yeah, I think it's been a remarkable 18 months for gold, outperforming equities and other dollar-based asset markets in 2024 and year to date as well. Looking ahead, I think there's an 80% probability that prices stay at these levels, at these record high levels in the mid $3,000 an ounce level, or they go higher and approach kind of the 3,500 to 3,900 an ounce range towards the end of this year and approach $4,000 an ounce. So that's kind of an 80% flat to higher from here. A bear case scenario would be gold breaking below 3,000, 3,100 and getting to the high $2,000 handle. However, I think there's going to be a lot of cash on the sidelines that will look to buy that dip. I don't think the gold trade has been overcrowded or overexposed in this recent rally. If we just look at things like ETF positioning data, COMEX futures and options positioning data, and so forth. As far as the price outlook, Lex, I just want to highlight 3 things. So the first I already did, 80% probability. It's State Street Investment Management's view that it's going to be flat to higher over the next 6 to 9 months. The second thing is that the gold price floor has probably rebased structurally higher. So I'm looking at $3,000 gold as the new $2,000 an ounce. And what do I mean by that? There are periods in history where gold makes a new price floor after breaking through a ceiling. So the global financial crisis in 2008, 2009 is a great example. 1,000 became a price floor after being a price ceiling for the prior decades. Then $2,000 an ounce became kind of the post-pandemic floor. It was a soft floor. Prices averaged kind of $1,800, $1,900 an ounce. 2020, 21, 22, 23. But it was really then in late 2023 where that 2,000 solidified. And then $3,000 an ounce, which was breached earlier this year in 2025, I think the longer we stay there, that's becoming a new floor. And there are a lot of secular and structural drivers that have probably pushed gold prices to that level. And then the third point that I would make is that the positioning for gold and gold ETFs in particular is still in volume and tonnage terms very light compared to what we saw in 2020. So I think there's room and scope for this to expand, but really it was a physical driver for gold, central bank demand, Chinese demand, and drove this rally recently over the last couple of years, and now financial demand is catching up.
Okay.
So can I add to something that Akash just said that I think was very, very interesting when you said the new floor on gold, because I think there's another way to look at that too. And it's the dollar devaluation that's occurred since 2020 has been staggering. So you look at every asset that's been denominated in dollars, it seems to have gone up. That'd be stock, silver, platinum, copper, gold. So it's like, the reason I make this point is because people were like, there's this bubble that's inflating in certain assets. No, there's not. The dollar's just weaker than it was, and everything has to reprice. That probably is the $2,500 level to $3,000 level in gold. So that doesn't even really reflect any sort of FOMO trade, any sort of mass positioning, which I think that's yet to come. And that's why I think there could easily still be some more room to run. We didn't even mention global central banks who are buying gold at record amounts, records not seen in 75 years. Just today on Zero Hedge, this is Monday, the 14th. Just today, Zero Hedge came out with an article that in May, the Chinese government basically said they hadn't bought any gold, but Gold Council came out with their figures today that they had actually been buying gold in May to the tune of 15 tons. I mean, something small, but the world central banks are buying quite a bit of gold. So there's still a massive tailwind, in my opinion. And again, at the end of the day, I think it is mostly a vote of no confidence in the stewardship of our currency. And that's what the Bitcoin trade is probably too. And I don't think these people who pick one and not the other and are so sure of themselves, that drives me nuts. Plenty of room for two. Bobby, your thoughts?
Yeah, I agree with pretty much everything. Yeah, I do a forward look for Yahoo Finance every year. November of 2022, I said my favorite trade for 2023 was gold. And it was not only one of the best performing assets. In the way that I view risk, it was the best risk adjusted performing asset. And I see no turning back on that. When I look at gold, you're looking at 33 months going all the way back to November of 2022. You're looking at only 11 down months in that period of time. That's risk adjusted returns. That's diversification. And that's what I like about gold going forward. Jimmy mentioned this a while ago on a personal level. We've been called gold bugs and we're not. There's just no way of turning this trade around in my view. And I look at it technically, just to throw some technicals in there as well. Over the last, let's call it 4 weeks, there's been 2 instances of gold going from overbought to oversold. The biggest move down was less than 5%. That's a sideways correction. Sideways corrections are generally not guaranteed to be, but they're generally bullish trends that are likely to continue. So you look at it from all angles. One of the few things I think that could turn around gold is higher short-term interest rates coming from the Fed, which I don't see happening anytime soon.
Good points. Good.
Can I dovetail on something Bobby said? Just two very quick points. So one, he mentioned volatility, and he's right. Gold is a low volatility asset. So if I go back the last 40 years, going back to the 1980s,
I love this.
If I look at volatility periods and what volatility realized for the S&P 500 and gold on a monthly basis, gold realizes 1.3 volatility points less than equities and is providing you portfolio attributes that are very unique in a low correlation environment versus equities and bonds. On the same token, if I look at gold price performance just in recent months, and I think Bobby was hinting at this, gold is only down 5% from all-time highs when equities have had a V-shaped recovery. From mid-April of this year at peak trade tensions to mid-July of this year, we have had a V-shaped recovery in S&P 500. You can't deny it. Volatility has collapsed for the equity markets. Why is gold only down 5%, 4% from all-time highs? There's clearly something lingering or structural in the background. I think it can link to the dollar point that Jim was talking about. And I think some of these physical demand drivers from the central banks, from China retail, with the ETF flow story also very positive this year in particular and over the trailing 12 months.
Perfect. I love it. Okay. Keeping us moving along. Ready? What are the key macro or economic factors that you're monitoring to gauge gold sentiment, would you say? And we'll let Akash answer always first, and you guys can toss on in.
Well, not to steal Jim's thunder, but I think the dollar is really critical.
Yep.
So that, let me just frame it in background for the audience. Going into the US elections last November, sell side Wall Street consensus was that Trump would be a strong dollar president. And in fact, if you look in November, December, January, gold was underperforming in US dollar terms versus the rest of G10 FX. Then starting around February, you've started to see gold really outperform in US dollar terms versus the rest of G10 FX. Gold is, of course, up against every currency year to date, but it's really up against the dollar. And I think that points to some of those concerns Jim was talking about. What do I think some of those drivers are this year? I do think there's a post-Liberation Day impact on the dollar, where some investors might be questioning the US reserve status, US financial and fiscal dominance. I think another factor is also the Fed is becoming a little bit more dovish, a dovish pivot ever since to get technical, some of the Fed speakers, Bowman and Waller in June, they really kind of pointed towards the need for cuts and that the Fed might be acting late. And of course, we know this White House likes to tweet about that quite a bit. So I think that's another factor. And I think the third point is actually where the US fiscal and debt trajectory is and what impact that has on the dollar and particularly the back end or the long end of the Treasury curve. So I'm just going to wrap up here this segment with a very quick point. I mentioned earlier the V-shaped recovery in equities. I mentioned how gold is only down 5% in that V-shaped recovery. So the taco trade, if it wasn't happening, you would expect gold to really be in a correction territory in a bear market when equities are rallying like this, but gold is holding on. So I think the big thing is what's happened to the dollar since then. And the dollar since mid-April has actually continued to slide, making year-to-date lows in July of this year. And what has happened? Trade tensions might have de-escalated until recently again, but you had the One Big Beautiful Bill Act that was passed in Congress, in the House, and then Senate. What impact is that going to have on the dollar? Looks like it could add $3 trillion to the US debt and deficit over the next decade. I think that benefits that alternative fiat demand for gold.
Mm-hmm, mm-hmm.
So there's something that I want to mention because we've talked about central banks a couple of times. In 2016, 64% of the world's sovereign reserves were held in the US dollar and US treasuries. That number's declined to 57%. Is it a big deal? Well, on its surface, it's not a huge deal, but directionally, I think it's very big. So you have to ask yourself the question, the factors that push people to de-dollarize, which again, the freezing up, kicking Russia out of the SWIFT payment system and freezing up all their dollar-denominated assets was a big deal that accelerated the process. But the question becomes, geopolitically, are we making tons of friends right now that would cause everyone to go back to the dollar and all of a sudden clasp hands and be friends again? We're 2 weeks away from dropping bombs in the Middle East. So I think the answer to that is no. You mentioned a Federal Reserve that's pivoted to easing. I'll even double down on that, Akash, and say, if you look at their quantitative tightening program, they have almost stopped it over the last 3 months. The Fed balance sheet is now pretty much flatlined, where it used to be being decreased by $90 billion a month. In my mind, that's a de facto ease already. So maybe he wants to ease without making it look like he acquiesces to Donald Trump, pounding him over the head with a sledgehammer all the time. Maybe that's what's going on. But either way, we have a government that's spending a lot of money, a rest of the world there might be some point in time where they love us again and all want to use the dollar, but it's not today. M2 money supply is growing. There's a lot of factors that are pushing this still.
Mm-hmm. Yeah, I want to mention 2 quick things. First of all, to piggyback off of both of you, what you said on the dollar's down 10.5% since January 6th. So was some anticipation of the dollar getting weaker even prior to Liberation Day. I think the Trump presidency, the idea was a weaker dollar because people knew that he was going to pressure the Fed. I don't know if people thought that he might get to Jerome Powell or not. Doesn't seem like he's getting to him at this point. But when you look at it from that perspective, the dollar has been under pressure and gold has continued to benefit from that. You guys both mentioned the devaluing of the currency, which seems to be the only likely next step from the Fed and their very small bag of tools that they have.
Bobby, do you think he's caving to Donald Trump, or
no,
he's specifically not caving to Donald Trump, even though he should be easing rates?
Look at the dot plots. Okay, the summary of economic projections that we all call the dot plots, the SEP. They've been pointing to more rate cuts since before the election. So I think we're seeing a Fed that only wants to cut rates. They don't see any reason to even go from right now. We've got a neutral to easing bias. We don't have a neutral, a tightening bias. And we don't have a flat neutral bias, right? So they say they're data dependent, but they're not, right? They have a bias. They're biased toward easing. They show that in the SEP, the dot plots. And when you look at inflation specifically, which I think is probably 1B to the dollar being 1A, is you've got deflation. It's definitely a downward trajectory. You don't have, well, maybe a disinflation, but we can argue about that point. And so far, the tariffs have not been inflationary. And Jim and I have been arguing for months that they're not going to be, since tariffs are a tax and taxes are deflationary, because they reduce the amount of money that consumers have to spend. And in a deflationary environment, contrary to what most people may believe, if there's deflation because of a slowing economy, and if you look at the CPI, you just go to the St. Louis Fed's website, pull up CPI, the only time you get lower inflation is during recessions. That's it. Otherwise, the curve is always up and to the right. Inflation is always, prices are always increasing. And based off of that, you should always own some form of gold, whether it's the ETF or physical or whatever, however you want to do it.
It's for purchasing protection, right?
It is, because there's always inflation. And as Jim has mentioned, since I've known him, the Fed wants inflation. They've designed it to be inflationary. They're designing the economy to be inflationary. So there is never a point, in my view, where you shouldn't have some gold. And I think the current situation, even though it might be, we might have deflation, it's because of a slower economy. And in a slowing economy, gold performs well, again, on a risk-adjusted basis, because the competitive assets are not performing well. Gold is the only thing I know of that's an asset and a currency. It's the only thing. I dare anybody to name something else.
Great. Good, Akash. Perfect. All right. Moving along. How have financial and gold ETFs, how are the flows been in 2025, would you say?
Yeah, Lex, they've been strong, but not the strongest in history. So if we look, we've had ETF inflows globally, as well as at State Street Investment Management, which manages the largest gold ETF suite, in 5 of the last 6 months. And if I look at the last 12 months, in 9 of the last 12 months, ending June 30th of 2025. So inflows have been strong, but despite that, Lex, total tonnage held by ETFs globally in physically backed gold is still down 18-19% from the 2020 all-time highs. So I do think there's room to grow, and the ETF trade is not so crowded. Just anecdotally, we're getting more reverse inquiries, more questions, particularly from intermediary, broker-dealer, wirehouse channels this year than we were 6-9 months ago in 2024, when gold was having its stellar run last year. Maybe some of that is, hey, I missed out on the gold trade. You know, can I still get in? Where should my positioning and allocation be towards gold? I didn't have enough of an allocation last year. But I do think the ETF flows have been very strong, but not at a level that I can't see them, that they shouldn't be able to continue growing over the next several quarters under the right macroeconomic conditions.
Right. Jim, Bob, any thoughts there?
I do have one thought on that, and I don't know much about flows to ETFs, obviously, because that's not my business. But I will say this anecdotally, is that I've started to get calls from friends who are not very sophisticated in financial markets saying, hey, should I be invested in gold? And I'm like, dude, yeah, we talked about it 5 years ago when I was talking, but anyway, nobody listens back then. But this to me means one of two things. And I think what it is that we are about to go into the next stage of an actual FOMO trade that may push the price gold up to stretch levels. Because I don't think that's happened already. Because if I had seen, like in Bitcoin, if I start to get that after the parabolic rise, or let's say in copper or platinum, I'd say, this is probably over for the time being, because the fundamentals don't back it up quite as well as it does gold. But when I'm hearing it in gold, to me, it seems like the door is starting to be kicked open for the next leg higher. That's all I'd say to that.
Yeah, the only thing I'd add to that I think was a really interesting turn of events was that gold flows turned positive in the EU for the first time in a long time.
Mhm.
And, I look at World Gold Council for that. I don't have any inside information on this. It's all public information. And this is from the World Gold Council. Europe's ETF inflows finally turned positive in the first half of 2025, following nonstop semi-annual losses going all the way back to 2022. So this is global. This is not just us talking. It's not just the four of us saying we like gold. It's a global phenomenon. And that's, I think, part of the reason we have sideways corrections in gold, as opposed to downward price corrections in gold.
Okay, good. I know we've talked a good bit about the central bank demand for gold just here. Any other important points that we want to make about, the central bank and the gold narrative and the official sector has on gold prices there? Anything else about the central bank you want to add?
One thing I would like to add too. Oh,
yeah,
you
go ahead, Jim.
Okay. So the last thing that Donald Trump said about charging tariffs to anyone who sides with or sidles up to the BRIC countries who are talking about using a non-dollar denominated means of trade. That's interesting to me. And this is going to be the one thing I'm going to put on the side of the whiteboard that says a potential negative in the future. Because if Donald Trump is successful at bringing everybody back to the dollar and bringing everybody back to treasuries. By the way, tall order, I know, but that could be something that pauses the gold trade into 2026. I don't believe that's going to happen. The other side of the whiteboard that has the positive fundamentals still outweighs that, but it's one thing I think is interesting.
Okay.
I'll just say two things very briefly. Just empirically for the audience, central bank demand for gold being positive does two things. One, it lifts the gold price floor, and two, it damps downside price volatility. And why is that? It's because the central bank is the most price inelastic buyer. Jim, Bobby, myself, you, Lex, we have nice portfolios, but we're limited by income. We're doing this podcast because we kind of have to. We're not on the beach right now. So from that context, a central bank technically has unlimited funds, right? They're printing fiat currency, but they're also not buying for alpha or just returning, getting the highest return. They're buying for geoeconomic, geopolitical, and geostrategic reasons with a very long time horizon that you could colloquially say is infinity, but in realistic terms, we're looking at 20, 30, 40 years. So it was a multi-decade trend of central banks selling gold following the Nixon shock in 1971 up until the global financial crisis. It's now been 15 years of net buying after the global financial crisis. And dare I say, I think it can be, we're in the middle of a multi-decade trend of central bank accumulation of gold as a reserve asset.
Akash and Bobby, can I ask you guys a quick question? You guys agree that there is incentive for global central banks, particularly ones that are not particularly friendly to the United States, to lie about their gold purchases and their gold holdings and potentially have way more than they say. Akash, do you think that that's a factor in this?
I think that's possible. If you look at the data, there's kind of allocated reserves and unallocated reserves. And interestingly enough, over the last decade in particular, a lot of the unallocated or unknown gold holdings as part of the total central bank figure that has grown. That's number one. I think the second is just the movement of onshoring gold. So if you have the US dollar open to sanctions policy, then gold is a bearer asset. It has no credit risk. It has no liability. So if I own that gold onshore, I at least can use that, even if it might be more challenging under a sanctions regime. Country A can use that to interact with country B through a different mechanism as opposed to dollar sanctions, which we saw how it crippled Russia in 2022.
So real quick, I think that, and I'll try and do this as quick as I can.
He never does anything quick, Lex. Just to be clear.
I just can't. Basically, look at it from this perspective. If you are not finished buying gold, you'd like the price to be as under control as possible. So yes, there's incentive to say, no, we didn't buy that many because they're not done buying it. That's one of the things that I see. I never tell anyone I bought a stock if I want to buy more of it.
Yeah.
Right. It's with
everyone else isn't going to buy it first.
So that's number one. The minute you're done buying, you tell everyone you bought it. We're still buying. We're crazy for it. And the price goes up and you win. That's number one. Number two, what I wanted to point out about what you guys were talking about a second ago Jim and I talk to a lot of people on our Trade Air show every week, and a lot of them have views of the dollar. We talked to one a couple of weeks ago who said the dollar's never going to not be the reserve asset. It'll always be the reserve asset in my lifetime, in my kids' lifetime. Jimmy, the numbers you pointed out, 67%, I think, down to 54% or 51%.
64 to 57.
The dollar can still be the reserve asset, and it could only be 40% of the global holdings. And you could have 35% gold, 5% Bitcoin, and what's left? 20% euro.
Yeah.
And you could still technically call the dollar the world's reserve currency at that point, because it's the highest held in terms of percentages. Mm-hmm. And this is why I say gold is so important, because again, I call gold a currency. It's the oldest currency there is. And I also call it an asset. And that's why it goes up when there's inflation, not because inflation and gold are linked. It's because it's an asset. And with inflation, you get asset inflation, just like your homes, your land, your stocks, right? Inflation is not bad for assets. And gold is also seems to be, based on the global appetite for it, the only real currency out there that we can trust.
Mm-hmm. Real quick, Bobby and Jim, I didn't know if you guys knew. I wrote a report about it that's on the State Street website in the last month. But gold actually overtook the euro as the #2 official reserve asset in 2024. So
I saw that.
It's already that change is moving. Yeah,
I saw that, and I used it on one of our shows.
The Europe is a museum. China's a prison. Japan is an old folks' home. Where are you going to invest? The dollar or gold, right?
All right, moving along, we're going to go to China. So it's so important to commodities, for commodities. How does China, the demand from China, fit into this gold equation?
It's phenomenally important, Lex. Mm-hmm. So Jim, Bobby, and I have been talking about the central bank gold demand story. You read Bloomberg headlines about it, Reuters news headlines about it. China retail, not the PBOC. Let's strip out the central bank of the People's Bank of China. Mm-hmm. Just China non-monetary retail demand of gold over the last 3 years has eclipsed central bank demand globally, including the PBOC, for what they report. Over 1,300 tons per annum. So everyone is talking about 1,000 tons per annum of gold demand, which is 25 to 30% of primary gold mine supply. Chinese retail has bought over 1,300 tons every year since 2022 as well. So why are they doing that, Lex? I think it's to hedge their own currency, CNY devaluation, the Chinese yuan. I think the property market never has fully recovered post-pandemic. So you have some capital being allocated towards gold. And for lack of better term, and I'm not making light of it, but gold is very democratized in China. You can buy it in 1 gram units, 5 gram units. So it's very accessible to kind of the broader population. And in that context, China has capital controls. So if you want to hedge A-share exposure, you want to hedge local property market exposure, it's not like you have 1,000 different ETFs and investment vehicles to choose from in the offshore market. Gold is one of those global fungible assets that China allows the population writ large to invest in. And they seem to be supporting more of it, with insurance companies and insurance schemes being allowed and encouraged to own gold for the first time due to policy changes within China.
Mm-hmm. Mm-hmm. I want to just throw in real quick. I want to throw India in there as well. $69.4 billion worth of gold purchased on the retail side in India in 2024. The expectation is expectations I've seen between 59 billion and I think 63 billion for 2025. Same thing. The retail demand is just dramatic.
But Bobby, can I ask you a question about, because I was going to ask a question about India too, because historically the retail demand in India has been quite high, but it's like, it's not like they were stacking gold. This is my understanding of it. And this question goes to jewelry. It's not like they were stacking gold bars. They're buying jewelry. One is like a celebratory thing to show wealth.
Weddings, festivals.
An actual store of wealth themselves. Is that accelerating, Akash, or is that just the same great demand for decades?
Well, the government has made some policies that has helped accelerate this story that Bobby's talking about. So they lowered the GST tax, they lowered import duties in the middle of last year. And I think that has shifted out the demand curve there. India is also a pretty strong economy within Asia. You know, India is now growing. Its GDP growth rate, not its actual nominal level, but its growth rate is greater than China's right now. So within that context, as you implied, as wealth grows in India, gold is viewed as cultural, as significant, almost a religious instrument there. There's a joke in the gold market that maybe 25% of the world's gold is actually held at Hindu temples and various religious institutions in India that will never come out. So I think from that context, yes, I think from a policy standpoint, but also from a GDP growth standpoint, India is seeing the potential for tailwinds for demand there over the next few years.
Also, don't sleep on Italy. 1.6 billion. Just saying.
Wait, where are you from again?
Right.
How much are you, Bobby? How much are you responsible for that?
He's got pinky rings that are like a ton.
Yeah, I bought my first gold coin in 1986. I think that was about 18 years before GLD, somewhere in that range. I don't know when the actual GLD launched. But I bought my first gold coin, but it wasn't my first piece of gold. I had my first piece of gold. I think well, I don't want to get that graphic. I was less than a year old wearing gold. So I'm just saying, don't sleep on Italians. We got a big hand in that.
Jimmy, Bobby had a pinky ring when he was 8 years old. I love it.
I had a pinky ring and a gold chain on a rope chain. I have to go with. Now I go with the Cuban link, but go ahead.
I love it. All right, good. So we're doing this in 2 episodes. We're going to tie up episode 1 here.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.